Welcome to The Explainer. Today we're diving straight into a truly fascinating piece of quantitative analysis by Bezdjian. We are going to treat this almost like a whiteboard session to map out exactly how leveraged ETFs function under the hood. More importantly, we'll see how you can use Rob's mathematical framework to trade right alongside the issuers themselves. We're ignoring the flashy headline returns and going straight for the plumbing. Let's get into it. Right off the bat, I want to hit you with a massive paradox that hooked me immediately. Think about this. If a leveraged ETF gains, say, 10,000% over a decade, how is it mathematically possible that the investors in that exact fund structurally lose billions of dollars in the aggregate? It sounds completely impossible, right? But Rob's paper reveals exactly how those massive headline gains actually mask a systematic, almost engineered wealth transfer from retail investors straight to the product manufacturers. To really grasp the stakes here, we've got to look at the sheer scale of this ecosystem. $25 billion. That's the assets under management for ProShares Ultra Pro QQQ. You probably know it by its ticker TQQQ. It's the biggest leveraged ETF out there, and people constantly cite it as the ultimate proof that these products work. Because this pool of money is so incredibly huge, it's the absolute perfect case study for our explainer today. Looking at TQQQ's share price since its inception, it's an absolute rocket ship of a trajectory. But Rob's core finding is a total paradigm shift. He points out that when it comes to leveraged ETFs, the price chart, it's essentially an illusion. What actually dictates the profit isn't the chart at all. It's exactly who holds how many shares and exactly when they hold them. And that brings us to what the paper calls the price versus dollars paradox. See, a product can post a staggering percentage gain on a tiny, leftover number of shares, what we call the residual float, while simultaneously reflecting massive investor losses. How? Well, if the bulk of the money flooded in right before a crash and then completely exited right before the recovery, the structural asymmetry is just profound. Investors end up heavily overweight during the brutal downturns, eating all the amplified losses, and severely underweight during the recoveries, totally missing the amplified gains. Section 1. Anatomy of the wealth transfer. To truly understand how this wealth transfer operates, we have to look at the daily creation and redemption flows of these ETF shares. And the footprint here is wild. Across 9 major market cycles from 2010 to 2025, over $25 billion of new exposure was created during periods of market stress and drawdowns. Meanwhile, roughly $20 billion was redeemed during market rebounds. Think about that for a second. Wall Street is literally printing shares when the market is falling and destroying them when it rises. It's a fully counter-cyclical design that perfectly serves the issuer's incentives. Let's put some hard numbers to this with a recent cycle to prove the math. Take a look at the data for Cycle 9 from February to April 2025. The S&P 500 dropped nearly 19%, and TQQ totally collapsed by 57%. Yet, during that exact same window, the shares outstanding actually expanded by over 44%. More than $9 billion of incremental issuance happened right as the price was falling off a cliff. Why would they do that? Because expanding the share count during a drop increases their fee pool, and it completely monetizes the mathematically embedded decay of the product exactly when retail investors are absorbing all those losses. Moving on to Section 2, the whiteboard, the DLDR trading blueprint. Okay, whiteboard time. How do we actually use this information to our advantage? Rob lays out a strategy called Day Late Dollar Richer, or DLDR for short. It's brilliant because it literally just replicates the behavior of the issuers themselves. Step 1, you track the prior day's net flow of shares. Step 2, if you see net creations, you short or sell a fixed fraction of that flow at the very next day's net asset value. Step 3, if there are net redemptions, you buy or cover. That's it. You are simply using Wall Street's own issuance behavior as your exact trading signal. Now, I'll admit, when I first read through the research, I kind of assumed DLDR was just a short-only strategy. I think a lot of people make that mistake, but no, absolutely not. If you dig into the exact formula from Appendix A of the paper, it clarifies this beautifully. It shows that if the change in shares is less than 0, meaning a redemption, the strategy dictates that you actually add to your position. That mathematically proves you can capture the long side of the cycle during rebounds. It's a highly dynamic two-way strategy. You fade the creations, and you ride the wave of the redemptions. And guys, Rob's work is really interesting because the math holds up incredibly well. When he simulated the strategy scaled way down to just 1/100,000th of the actual market size, basically mimicking a single retail trader, it generated roughly $288,000 in profit on this perfectly smooth upward curve. If you linearly scale that up to the institutional level, it implies billions of dollars in structural advantage. These flows aren't random noise. They are a highly predictable, totally monetizable signal. Section 3. Alternative implementations. Drafting behind the issuers. So, what if you were structurally constrained and you just can't outright short an ETF? Well, Rob articulates some really precise alternative methods to effectively leverage what's happening. First up, you could short the inverse product, SQQQ. Second, you could use the options market, buying long puts or put spreads on the unlevered QQQ index specifically when those massive creation signals flash, effectively capturing the downside momentum. And finally, for the more sophisticated funds out there, you could put on a pair trade, shorting the leverage ETF while going long the unlevered base index. That setup isolates the mathematical decay to your advantage, capitalizing on those underlying flows without taking on the raw market direction risk. Let's zoom in on that first alternative for a second, shorting the inverse product. Looking at the linear scale, SQQQ has decayed by more than 99% since its inception. These inverse products essentially complete the closed ecosystem. The long products showcase massive headline gains on shrinking floats, while the inverse products literally exist to recycle investor capital into pure mathematical decay. Shorting that decay, based strictly on those daily flow signals, is a wildly powerful complementary approach. All right, final section. Section 4. Fiduciary, legal, and market implications. Crucially, this isn't just a trading playbook. The systemic consequences here are massive. Rob actually provides a roadmap for legal counsel, pointing out that placing these predictably decaying assets into retirement plans like 401ks could represent a serious breach of prudence under ERISA. You've also got potential Advisors Act violations if fiduciaries are distributing products that are structurally aligned against their own investors. But the most damning concept here is what he calls avoided liability. By redeeming shares during market recoveries, these issuers completely avoid having to pay out those leveraged gains. It's a built-in, highly quantifiable transfer of wealth. Which brings us to our final thought for this explainer. We constantly hear people blame retail psychology or bad market timing for why people lose money in leveraged products. But looking at the pristine, statistically predictable nature of these creation and redemption flows across 15 years, we really have to ask, is this so-called psychology actually an engineered illusion? Rob's research makes a powerful case that this isn't a bug, it is an incentive-consistent design. It's a call for all of us to look past the shiny charts, follow the primary market flows, and finally see this market for exactly what it is.